Give me a quick check on market sentiment and direction as we stand. You heard there tech stocks leading the declines on Wall Street ahead of this really important US CPI print, which is going to give us more clues on the Fed trajectory from this point on.
Dan, with regard to sentiment, if we look at the positioning of speculators in the S&P futures, which is a good barometer for sentiment, they're still very net short. There was some short covering during the summer, but even so, they're still very short. And I noticed that none of the big bulge bracket firms in Wall Street have a year-end index target for the S&P that is higher than where it is now. So a contrarian would be viewing that positively. With regard to inflation and interest rates and the impact on the S&P, the irony is that higher rates are actually earnings accretive for the S&P. And I know that sounds counterintuitive, but the average debt maturity of the large caps is around 7 years. So it's going to take a long time for these interest rates to start hurting them in terms of higher interest payments. And on the other hand, these big tech companies like Apple have so much cash on their balance sheets. Apple's net cash, for example, $60 billion, that, with interest rates having gone from 0 to 5%, they're actually making even more money than they were before because now they actually have this big interest income. So I noticed the consensus turned positive for third quarter year-on-year earnings growth for the S&P. And if that's true, it'll be the first positive earnings growth in 3 quarters. And ultimately, earnings are what drive share prices. So we think the consolidation ends around the middle of October, and then we're going to have a positive fourth quarter.
Okay, so walk me through that positive Q4. We're watching for a market bounce, as you say, and as a result, you're overweight US equities and investment-grade bonds. Why do you want to be exposed to this space if we do see a bounce in Q4, and ultimately, what will drive it?
Ultimately, I think what will drive it is the earnings for the stock market, as I said, and I mentioned the third quarter should be positive year-on-year, barely, but if you look at next year, earnings should be up at least 10% over this year, and that'll be a very welcome respite from the negative earnings of the last 3 quarters, as I said. And then as far as interest rates go and corporate investment-grade bonds, we think that inflation is going to continue to trend down, largely driven by the property prices, which, as you may know, shelters 40% of core CPI. And if you look at the real-time readings for rental prices, they've gone from about 12% year-on-year down to 0. We think that rent in the CPI will follow that. And therefore, it's possible to get around a 2% CPI inflation next year, around 2 to 3, in the 2s. And therefore, we can expect Fed funds rate cut sometime in the summer. We're thinking around July. If that's the case, it's around time now to be buying high-quality investment-grade corporate bonds, and they give you yields of about 5.5%. In real terms, actually, the yields are the highest since the global financial crisis.